Okay, and I just want to point out a couple of things on Canvas. For Chapter 5, the goal today is to finish up Chapter 5. So I want to show you Chapter 5, some material that's here. Part 1 of the slides, guys, is going to end up being all of the slides. Actually, I do have a couple of new things that I'll post up. Let me see. I can't remember now if I posted up the new thing or not. Now I can't remember. So maybe I will put a part 2 that will essentially finish up what we were saying last time. But there's a couple of new things in here. Yeah, okay, no, I do. I have the new thing. No, not quite. So I'll post up a part 2. Okay, because it's not everything here right now. So I'll go ahead. No, I did put it up. Never mind. So that'll just be the only part. So the part that you see as part 1 will be the only part, but any markups that I make, I will go ahead and post those as well. But you'll pretty much see everything up there that I'm going to go through today. Okay, so I'll post up the marked up version though. So you'll see a markup version that I'll post up as well. Okay, so that's the slides. The other thing that I want to draw your attention to is this example that we're going to go through today for long-term construction contracts. We're going to go through that example. We'll go through the quiz, and then there was a request, hey, can we have more things, more batting practice, more things to look at? And I made the comment that, I'm not going to be putting up a lot more quiz questions. We'll have the practice midterm and stuff, but of course, when you go into assignments, I will continue to post up assignments that will have various things that you want to work more on that. But that, again, that sort of becomes on you to make sure you've acquired the book, you've acquired Connect, you're getting in, you're seeing what those homework assignments are, etc. And then, of course, if you have specific questions about any of those, we typically won't have time in class to go over them, but you can always come to the office and ask questions about office hour, ask questions about any additional things you see in Connect. Okay, so just want to make sure that you're aware of the resources here that I'm going to be making available. And as I said, we're going to start with the discussion of accounting for long-term construction contract because we sort of stopped there last time. Somebody remind me not to close the slides without saving them so I can put them up on Canvas. Okay, and I'm looking at the person who always seems to remember to remind me. Okay, so don't let me forget. Okay, huh? Okay, okay, cool. You can have the beepers going off or whatever. All right. Okay, good. All right, guys, so let's go ahead and let's jump in. And just a quick review of last time. Remember, we had what? We had the steps, and some of the key steps that we saw and some of the different things that we were looking at was, do we have revenue recognized at a point in time or over time? Do we have what? A single performance obligation or multiple performance obligation was some of the key things that we were looking at, and then we were applying those concepts to different specific examples, like what if it was a warranty? What if it was additional consideration, like the coupons, that sort of thing. We were sort of applying those concepts to different specifics. Okay, and we'll take a look at a couple of those type of things in the quizzes. And I think when you see them in the quizzes, it'll be a little easier to see how we're going to apply those to our actual exams. Okay, but before we get into those, another area is accounting for long-term construction contracts. So what happens? An asset is being built, it's a major project, say somebody's building a building or something, and the contractor is either going to recognize its revenue over time or at a specific point in time. Okay, now in most cases, it'll be the case that a contractor will recognize that revenue over time. Why? Usually with the long-term construction contracts, things are being made to specifications. Okay, and when things are being made to specifications, you start getting into the issues of there's no alternative use. The customer is going to be taking some ownership of that over time, some benefit over that over time, and so we're going to see that for the most part we're going to recognize revenue over time. In rare circumstance where that isn't the case, then we'll recognize that revenue at a point in time when the item that's being constructed is finally delivered to the customer. Okay, so we're going to take a look and when to recognize revenue. We say that revenue is recognized over time, and we call that percentage of completion method. We're going to see that we're literally going to calculate what percent we are done, and that's going to dictate the percentage of revenue. It's going to be as simple as taking the percent done we are times the total revenue on that contract, and that's the amount of revenue we'll be able to take at any point in time. Okay. Now this is the case is the customer, I should say, consumes the benefit of the seller's work as it is performed, or the customer controls the asset as it is created, or the seller is creating an asset that has no alternative use to the seller, and the seller has the legal right to receive payments for progress to date. Now, again, these are sort of generic considerations that we looked at for the other areas, but let's think about it in terms of a long-term construction contract. And I use the example of somebody doing construction in my backyard because, did I say destruction? Construction in my backyard because I had the experience recently where I did that. I just bought this house last year, and the guy was building my backyard as he went along, and he was billing me, and I was paying him as he went. Okay, and so what happens? The customer consumes benefit of the seller as work is performed. Probably not really. I mean, I'm not going to be running around in wet cement while he's still working on it, but it has to be just any one of these. This might be the case. Remember, we saw the health facility, the health club, where they were taking the benefit over time, and it was just how many months or whatever. Okay, so that's more that situation. The customer controls the asset as it is created. Now I look at that and I say, well, that is definitely my backyard project, because he can't take my backyard from me. What is he going to do? Come with something and just chop off my backyard? No. As he's building that stuff, I am getting benefit. Even if he stops there, if something happened and we ended the contract, I still have the work he did up to that point, right? So percentage of completion would be applicable in that situation. And the seller is creating an asset that there is no alternative use. What's he going to do? Say, well, I finished John's backyard, but Mary, why don't you go ahead and hang out in John's yard and pay me, and now John has to let you, enjoy his backyard with the work that I did. No, there's no alternative use, right? Okay, so you don't have to meet all of these, but situations like that, you can see why we could use percentage of completion for these sort of a deal. Maybe I own the land, and I'm asking you to build a building for me on that land. Well, obviously, I own that land. It's not like somebody else can be able to come and take advantage of that project as it's going, and it's going to end up being mine. Now, if you don't meet one of these criteria, then we're going to recognize revenue at a point in time, and we're going to see that that is the completed contract method. And under that situation, we will not take any revenue until the contract is complete. Okay, most contracts will qualify for the percentage of completion, but we'll consider completed contract method as well. Okay, regardless the amount of profit we get on the contract, regardless of the method we use, the total amount of profit that we get, the total amount of billings, the total amount we'll pay is unchanged regardless of what method you use. It's simply what? Am I recognizing this revenue over time, or do I recognize it at just one point in time, completed contract method, when the whole thing is over? Okay, so let's just go ahead and take a look at some key aspects of the percentage of completion method. Again, aka otherwise known as what? Recognizing revenue over time. Okay, and under percentage of completion method, determine the recognition of revenue. Income is recognized in the percentage of completion as the percentage of the incurred cost to date bear to the total estimated cost on the contract. Now you look at that, and guys, that is the typical way that we will do it in most of the problems that we're going to look at. And we're going to see that we're going to be looking at cost to date versus total estimated cost of the contract. And you look there, that's a cost to cost analysis that we'll be doing. Okay, and then it could be that they may indicate that such revenue progress completion is appropriate to the work performed. However you measure that, they give you other ways other than cost to cost. If cost to cost is not available or acceptable or the best way to do it, they say use some other method is all they're saying there. Okay, but we're going to focus on cost to cost. That's the most common. Okay, so you come over, and I have the steps here for determining the percent that a entity is complete to any point in time. Now these steps that I have here are basically the way to answer the problems on your quiz, to answer the problems on your exam. I'm going to show you a longer method with the journal entries, a longer approach with the journal entries, the whole works. But this is a quick way to answer a question if all I do is ask you for the profit. And we'll see how we'll apply these to some of the questions that I'm going to be showing you here in a little while. But you have the cost of the contract minus the estimated total cost. That gives you the total amount of profit we're going to get on the contract, right? Contract price minus the estimated total cost is basically our estimated gross profit. Now, if we want to figure out what percent done we are at any point in time, we take the total cost that we've incurred to date and we divide that by the total estimated cost of the contract. So if the total estimated cost of the contract is $1 million and our cost to date is $400,000, what percent done are we? Not a trick question. If we think, Good. If we think the total cost to date are 400,000, we think the total cost of the contract is going to be $1 million, we would be 40% done, right? Okay, good. Then just to entertain us here, what's your name, sir? Peter, just to entertain us, what if I'm 600,000 is the cost to date, and I think the total estimated cost to complete is $1 million? It's going to be 60%. Good. So it's just that simple. Okay. Now, when we compute the gross profit earned for the year, we will take the total profit we think we're going to earn on the contract, multiply that times the percent done we are, but that gives us what? The total profit estimated on the contract. To figure out what we've earned this period, we took the total profit on the contract minus any contract we have earned at the beginning of the year, gives us what? The amount that we must have earned in this year. Okay, so these are the steps that you would go through if you're just trying to get the profit piece. We're going to see that we're going to apply a very similar approach here when I go through the journal entries if we're trying to figure out the amount of revenue at any point in time, any particular period that has been earned. Okay, now under the rule of conservatism, if you have a loss on a contract, you must take the entire loss immediately. Whatever you estimate the loss to be, you must take that immediately. So if you're sitting in a situation where all of a sudden a profitable contract becomes a loss contract, you need to not only take the loss for that period immediately, but you need to take a loss big enough to wipe out any previous period's profits and catch your loss up to date at that point in time. And you take all losses immediately. Okay, so let's just go ahead and jump to the example here, okay? And then I'll come back and say some more things about completed contract in a minute. But I just want to take a look at this example where we have the sales price on this contract is $4 million. The total estimated cost of the contract at the end of year one in this example is $3 million. And in this example, we say in year one, the cost incurred to date are $1,500. And you're going to see that we'll have other years here, but let's just focus on year one to start this whole thing. So year one, I sit here and let's just jump down to the percent complete I am. I have what? I have $1,500 cost incurred to date. The total estimated cost of the contract is this is in thousands, so it'd be 1.5 million divided by 3 million. So I think I am what? 50% done, right? Okay. Now, let's just use that for the example that I'm going to jump to now, which is you see that on iLearn, it was the example that I showed you, okay, the Excel file that you can see up here on the screen now, which is a little bit hard to see, but I'll make it a little bit bigger up here so you can see what's going on. You can see I have year 1, 2, 3, 4 tabs, just like the 4-year example in the thing that we were just looking at a minute ago. So this is expanding that example beyond just the recognition of the profit. That thing that I showed you a minute ago is just trying to show you how could you quickly calculate the profit on this year to year, profit or loss on this year to year. What I'm doing here is giving you a more comprehensive example where I'm showing you year 1 under percentage of completion. We had spent what, 1.5 million on that, and so we obviously credit cash, accounts receivable, whatever, guys. It doesn't have to be cash. I mean, not accounts receivable, accounts payable. Doesn't have to be cash, but I'm just going to sit here and I'm going to use cash every time, okay? And so what happens? Since I have spent 1.5 million on this contract, I debit the account construction in progress. Construction in progress is an asset account. It's an asset account, and it is like in my inventory, where instead of what? Instead of acquiring my inventory like a retail entity, I should say, would from a manufacturer, I am not debiting inventory. I'm debiting construction in progress because I'm starting to build this building, whatever it is, right? Okay, so I debit my construction in progress. It is an asset. Now, of course, I need some money, don't I? Okay, so I go ahead. Are we lost already? I'm on an Excel spreadsheet now, right? Okay. Okay, so I'm going ahead and I'm doing what? I'm debiting construction progress, I'm crediting cash. Then what? Then I'm going ahead and I'm assuming that there have been billings here of $1 million. I mean, this company can't function if it doesn't have cash at some point, right? That's coming in. So I go ahead and I debit accounts receivable for $1 million, and I credit this account billings on construction contracts. Okay, debit account receivable, crediting billings on construction contracts. Now you look at these two accounts, construction in progress and billing on construction contracts. These two accounts will always be netted against each other. And if my construction in progress is more than my billings, I will show a current asset on my balance sheet because I have more work that I've put into this than I have actually billed the customers. This is not a good time to take a nap, I promise you. You will wake up and you'll go, oh, he's going too fast. It'll be because you slept through 20 minutes. It'll seem like I filled 20 minutes into 20 seconds, okay? So don't sleep on me, okay? So what happens? We sit here and we debit the construction in progress, we credit the billings. Right now, the billings has 500,000 less. So we're going to see that we will have a current asset because our billings are more than what we put into the project at this point in time. Okay. Now, since we're recognizing revenue as we go along, when we come to the end of the year, we will have to recognize our revenue. Okay. So what we will do is we will recognize revenue for, and remember guys, the total contract price was how much? 4 million on this thing, and we said we were what percent done? 50% done. 4 million times 50% is going to be $200,000 of revenue we could recognize this period. Now, since we haven't recognized any revenue to date, since this is the very beginning of the project, we're going to be able to take revenue of 2 million on this. Okay, so we got revenue of 2 million, and I guess I want to try to expand that first column a little bit more because it looks like it cut off my 4 million. Okay, and so 4 million times 50%. We haven't taken this 2 million. We haven't taken any revenue so far, so we take 2 million, right? So we have to credit the revenue 2 million. Now we have spent what? 1.5 million on construction, haven't we? So we debit this expense account called construction, cost of construction, 1.5 million, because that's what we've spent so far on the what? On the construction. And we can do what? We can debit the account construction in progress. We are going to include in that construction in progress asset now the what? The profit portion of our revenue, aren't we? Okay, so we take 1.5 of cost, but then the additional 500,000 goes in to our construction in progress. Okay, now just to review how the financial statements would look. And I just started at the beginning of the year. I assumed cash of 1.5 million, and I'm just going to assume all that cash was contained in common stock. Maybe we issued some common stock for 1.5 million, right? So we're just sort of starting this company. Okay, then what? Then by the end of the year, what? The cash is zero because we did credit cash 1.5 million, didn't we? Okay. The accounts receivable is now 1 million. That's for those accounts receivable that we had bid on. Where's my account? I'm not bid on, but we had billed on, which is what? Debit to accounts receivable for 1 million. Okay, so we got accounts receivable sitting here of $1 million. We've got cost in excess of billing 500,000. How did we get that? Well, that's our what? That's our billings at this point, which are 1.5 million minus my construction in progress. Construction in progress is the 1.5 million that I had put in the beginning plus the profit, right? So since my construction in progress is more than my billings, I can carry that as a current asset of 500,000. So I've got that current asset of 500,000 now. And then looking at the balance sheet, I have that asset. That's a current asset, cost in excess of billings. I don't have any liabilities right now. There's my common stock of 1.5 million. The what? The balance sheet balances right after I have, actually that 500,000 at that point would be the difference between the account receivable of $1 million and the billings of $1 million, I should say at that point. I jumped a little bit. The billings of $1 million versus the construction in progress of 1.5 million. That's just after I've paid that money for the construction. Okay. Then I go over and I prepare my income statement. My revenue is 2 million. My what? Expense of my construction, cost of construction was 1.5 million, so my net income is 500,000. Okay? So now when I prepare my balance sheet, the accounts receivable is still $1 million. Cost in excess of billings is now what? 1 million. It's the what? The 2 million that's in construction in progress. It's the original 1.5 that I had put in there plus the 500,000 of the profit that I put in. So that's 2 million versus the 1 million of billings. So my cost in excess of billings is $1 million. And then I have my common stock still of 1,500,000 and my retained earnings. And guys, I didn't go do closing entries, but I would have closed my revenue, I would have closed my construction expense account, and I would have credited income summary retained earnings for the difference and ended up with this 500,000 in retained earnings. Okay. Question. I just made it up. I had to have cash. If I'm to start paying cash, I needed cash. So I just went ahead and said, okay, I got 1.5 million cash. How did I get the cash? I guess I issued some common stock for 1.5 million, just so the balance sheet would balance at the beginning. So just an assumption. Okay, so a couple of important takeaways here. What? As we spend money on the contract, we do what? We debit this account, construction in progress, don't we? Okay, well, first of all, how do we figure out what percent done we are? Maybe we start with that. Cost to cost, right? Okay, but as we spend money, we do what? We take our construction in progress, we debit that, we credit cash or whatever as we're building this thing, right? So we're building up this asset, which is like an inventory. When we come to the end of the year, we look at what percent done we are. What have we spent to date versus what are the total cost of that contract? Okay, so that gives us the percentage done. We multiply that by the total revenue, and that gives us what? That gives us our revenue to date. We know we have to credit the revenue, don't we? We do what? We debit the expense and we simply do what? Plug the profit at that point. Now we could have also figured out the profit. I'll show you how we could have figured out the profit separately. But at this point, the profit's just a plug to make the journal entry balanced, isn't it? And that profit goes to what? Construction in progress. Thus, we're capitalizing the profit and the cost into that construction in progress, right? But when we mail out our billings, we debit accounts receivable, obviously. We credit what? We credit our billings account, and then at the end of the year, we compare what have we billed versus what? What are the costs, including any profit that we've accumulated in the construction in progress account, and we compare those. If our cost plus profit is more than the billings, we have a current asset called what? Cost, and they don't say cost and profit, but it really is cost and profit in excess of billings. That's not the correct title of the account, but it really is that. The correct title is cost in excess of billings, or what? And we're going to see in a minute, we're going to bill more than our costs. Then we have what? And it toggles back and forth between an asset and a liability. We would have a liability called billings in excess of cost. And if that was the case, we would have that. And then, of course, we take our profit to retain earnings. Question? Yes, sir. I made it up. Oh, which 2 million? There's a couple of 2 millions up here. Huh? Revenue? Oh, that I didn't make up. The 2 million on revenue is the 4 million that was on the contract that we saw a minute ago, times the fact that we were 50% done, right? So we're able to take 50% of the revenue. Okay, so that's where we knew we spent 1.5. So it's a weird accounting because we do what? We capitalize it as construction in progress as we credit the billings. At the same time, we what? Treated those costs as expense, don't we? And then to come up with the profit, at least in the journal entry situation where you're making the full journal entry, it's simply the plug to make this journal entry balanced, doesn't it? And that's the profit we're able to take? Yes, my cost was 1.5 million going back to the original example. Cost in year one had been 1.5 million. I do two things with that number. I capitalize it to the construction in progress account, credit cash, whatever. I also debit it to an expense account while I'm crediting the amount of revenue I recognized, which was 50% of the revenue, the total 4 million revenue times the 50%. I credit that. I debit that. I also debited it for what? The 1.5 for construction in progress. Okay, and then the difference is the profit on the contract, 500,000. That also goes to construction in progress. So I capitalize the cost plus the profit to construction in progress, right? I go ahead, I prepare my income statement, 2 million of revenue minus the cost gives me net income of 500,000. I don't have any more cash. My accounts receivable are what? $1 million. My cost in excess of billing is $1 million. That's the 2 million that I have debited to construction in progress versus what? Versus at this point the pure million, the only $1 million that I have put to the liability account, billings. That difference is going to be what? Is going to be the $1 million. That's what I call this asset, this current asset, cost in excess of billings. My costs were including my profit, but they don't call it cost and profit. They just call it cost, but it includes my cost plus my profit, 2 million, versus the amount I have billed, which is what? $1 million at that point, right? Okay, so I net those out. There's my accounts receivable. There's the common stock, which I made up. The retained earnings, assuming it started with 0, now has 500,000, right? This is a lot easier to understand if you don't sleep. Okay, if you're not sleeping, I'm not talking to you. If you're sleeping, you're the person I'm talking to. Okay? Question? Okay. All right, good. You go over to year 2. Okay, just let's look at the example here for year 2. And now they tell me that what? Again, contract price is not going to change. I mean, if this was a military contract, they have something called cost plus. In military contracts, the contractors are allowed to keep just adding on and on the cost onto a predetermined profit, and they can just keep adding the cost on and on to a predetermined profit. That's why I get really upset when I see these fat cats sitting in these defense contractors saying, well, we shouldn't let people have welfare because they're living off the government. And I'm thinking, your whole freaking company is living off of the government. You spend what you spend, and then they add a profit onto the end. Okay, so usually in most types of contracts, the amount of this contract price will pretty much stay the same unless there's some sort of adjustment as we go along. But typically, that's not the case. Okay, we just sit here with this $4 million for the contract price. Now our total estimated cost of the contract are $3,200. We've spent what? We've spent $2.4 million. So we do what? To figure out what percent done we are at this point, it's always cost to cost. It is the total cost to date, which in this moment is, I guess I'll just underline it, is the 2.4 million total cost incurred to date divided by what? Total estimated cost of the contract. And that can change as you go along, right? Hey, you thought this thing was going to cost you $3 million. Now it's costing you what? $3.2 million? Can that happen to a contractor? Absolutely does, right? And so what happens? Now I determine that I am 75% done. So if I'm 75% done, don't worry, the rest of the bottom of this example is just showing you how to do it if you're dealing with profit. Okay, but let's go back to this Excel spreadsheet. Now we're in what? Year 2. Okay, now in year 2, I sit here and assume, and again, that original example I'm showing you didn't talk about billings. I'm just assuming billings amounts. Okay, so assume billings of 3.5 million in cash collection of $1 million. Now, from the example, I am knowing that they did what? That they spent another $900,000 in construction costs. How do I know that? 1.5 from year 1, and now they're telling me the total cost to date is what? 2.4, so they must have spent another $900,000. Okay, I'm not making that up. I'm making up the journal entry. I'm doing the journal entry that would have went along with that fact pattern. Okay, so we debit construction in progress. We credit cash now for the additional $900,000 we've spent this year, right? Okay. Now we go ahead and we bill, and we debit accounts receivable 2.5, and we credit billings on construction 2.5. And because I needed some cash, I went ahead and debited cash and credited accounts receivable. The collection of cash is irrelevant to this example. I mean, I'm just doing it so that I have some cash to continue to spend so my cash doesn't go negative, is the only reason I assumed and I made up some cash coming in. Okay, so what happens? Well, now I look and I'm going to recognize my revenue for year 2. And my revenue for year 2 is going to be this. Don't sleep. Don't sleep. You're not going to understand it. You're going to wonder what happened. You take the $4 million, which is the cost of the contract, times what percent, the sales price of the contract, I should say, times the what, 0.75 I'm done now using cost to cost. That gives me $3 million of total revenue I've earned to date. But I did recognize $2 million of that last year, didn't I? So this year I've only earned what? $1 million worth of revenue. Good. So I go ahead and again I debit that cost of construction account for the $900,000. I credit the revenue, as you just saw we calculated, and I debit construction in progress. I capitalize that revenue part, don't I? So if you think of construction, that profit part I should say, so if you think of construction in progress, it's the accumulation of cost plus profit that's been going on this contract, isn't it? Okay, so you go ahead and when you look at the construction in progress account, there was that 1.5 million, that was from year 1. Year 1's profit, now what? Year 2's cost plus year 2's profit on that, which we determined to be the 100,000. The $1 million revenue minus $900,000 cost. We debited that to construction in progress. So my construction in progress is how much? $3 million at this point. But if you look at my buddy what? Where's my buddy Billings now? I started teeing up Billings. There's my Billings from what? From year one. Here's my Billings from year two. So there is what? There's 3.5 million of billings in there. Notice, guys, accounts receivable is doing its own thing. What I collect on the accounts receivable, how much cash comes in, has nothing to do with billings. It's easy to get billings and accounts receivable linked up in your mind because what? You debit one, you credit the other. But what happens? Accounts receivable then decreases and increases depending on what I should say decreases depending on what I collect, and my cash goes up and down depending on what I spend and what I collect. So accounts receivable and cash are actually more the two accounts that are more linked to each other than billings and accounts receivable. Billings is what? Connected to my construction in progress, isn't it? Okay. Now I look and my construction in progress is 3 million. My billings are what? 3.5 million. So now I have billings in excess of cost, don't I? Okay. So when I go ahead and I prepare my financial statements, again, revenue is $1 million. The cost is $900,000. Net income's $100,000. My cash is, there's $100,000 left in the cash at this point, just to go up and check that. The beginning balance minus the $900,000 I spent this year. So my cash is $100,000. My accounts receivable are what? $250. That gives me total assets of $350. But now, because my billings of $350, I should say of $3,500,000 are more than my what? Than my construction in progress of $3 million. That what was an asset in year one turns to a liability in year two, doesn't it? So it flips back and forth depending on whether I have more in the billings account or more in the construction in progress account. Now, because I have more billings, this becomes a liability. Billings in excess of cost of $500,000. There's my common stock still, and my retained earnings is now the $500,000 from year one plus the $100,000 of profit this year. Does the balance sheet bounce? Does the balance sheet bounce? Okay. Okay, good. Any questions so far? Okay, good. Then you come over to year three. Okay. And in year three, I say assume no more billings, and then there's cash collections at 2.5. Now let's think about this no more billings because you might have trouble wrapping your head around that. We're in year what? 3 of this contract. We've already billed for 3.5 million, haven't we? And it's fairly likely that my customer might say, I'll pay you the rest when you're done because I want to see the finished product and I want to inspect before I get it. So it might be that they might hold back $500,000 till the final year, right? Okay, so we're not going to bill them anymore, but they do send us in some more cash of 2.5 million, and now our construction in progress is 1.2 million. We credit cash 1.2 million. Where am I getting that? Well, when you look at back to the little example here, notice that the cost incurred to date now are what? Are 3,600. So if I had 24 before, I must have spent what? 1.2 million more. Okay, so that's why I'm debiting construction in progress 1.2. I'm crediting cash 1.2. That's where that number came from. But you have an interesting situation now with this contract. Notice that we have a estimated cost to complete, cost incurred to date 3.6, and estimated cost of the contract is 4.2. Do we like this contract anymore? We do not like this contract anymore. We're going to lose money on this thing. And rule of conservatism says we have to take the whole loss on the entire contract immediately, whatever we perceive it to be. So we sit here and we say, well, look, We've spent so far 36, or total estimated cost to complete is 4,200. So what percent done are we? Who's got a number for me? 30,600 divided by 42, or 36 divided by 42. Don't worry about this 100%. Huh? Let's say 86, because I think it was 85.8577 something. So 86. We'll just use 86, okay? So we're 86% done, aren't we? Okay, but we know we have to take all of the loss. So what do? Go back to the Excel spreadsheet, and again, we want to figure out how much revenue, 4 million times what? 86% is roughly 3,400,000. We've already recognized profit up until now, what? 3 million, 2 million the first year, 1 million this year, right? Okay, so we've already taken revenue, 2 million the first year, 1 million the year two. So we've taken 3 million of revenue already on this, I should say. So that means we can take what? 400,000 of revenue this year, right? So we take 400,000 of revenue this year, but our costs were what? 1.2. And if you look quickly on the income statement, that's going to generate a loss of 800,000, and it should generate a loss of 800,000 because we have to now gross up to the total loss on this contract, which is 200,000, isn't it? The total loss on this contract is what we estimated to be 200,000. 4.2 estimated cost minus 4 million contract price. We're projecting a loss of 200,000, are we? But we've already taken what? 600,000 of profit. So we have to have a loss big enough to wipe out that profit from the first 2 years and now generate a loss of 200,000 in the current year. Okay, so if we take 800, if we take our cost of construction, that gives us a loss of 800,000. Have we accomplished our task? We're going to do what? Wipe out the 600,000 sitting in retained earnings, and now there will be a what? 200,000 net loss sitting in the retained earnings. Okay, and so we go ahead and we prepare the balance sheet now, and when we prepare the balance sheet, we have our cash is 1.4, just to keep you comfortable with cash, the 2.5 million cash collections minus the 1.2 we've spent leaves us 1.4 million of cash sitting there. Our accounts receivable now, remember we had no more billings, and I just assumed they collected everything that was in accounts receivable. They debited cash, they credited the account receivable, so now that is what? That is 0. Okay, we had no more billings, so our billings is still 3.5. And we did what? We credited construction in progress for 800,000. That was now, instead of putting profit, we're backing some profit out of construction in progress and sticking the loss in there, aren't we? Okay, so now construction in progress is showing us what? It's showing us the 3 million, the what had gotten up to 4.2 million, because remember we had the year 2 profit of 1 million. We had our debit to construction in progress when we spent 1.2 million, and then when we credit it for the loss, our construction in progress account now is showing 3.4. Okay, and so which one is more, the billings or the construction in progress? The billings has 100,000 more, doesn't it? Okay, so when we prepare the balance sheet, we have our cash, our accounts receivable are 0. Our liabilities, we still have billings on contracts in excess of cost. The billings of 3.5 minus the construction in progress of 3.4 gives us the billings. There's our common stock, and we have what? We have the negative now retained earnings of 200,000. That took out the what? The entire 600,000 we had last year, at the end of last year, plus now this loss, or taking out this loss of 800,000 this year, right? Brought us down to the 200,000. Okay. Okay, good. Now you get into year 4, and we spend in year 4 another 700,000. Now, where did I get 700,000? Well, so far we had spent, just go back to the little example. Okay, or maybe it's a big example. At that, we had spent what? We had spent up until that time 3.4. Now we're completing the contract and we spend another $700,000, don't we? So when we spend another 700,000, we go ahead and spend, what is that, $700,000 more, right? Okay, so we spend 700,000 more. So when you go back to the journal entries, we do what? We debit construction in progress 700,000. We credit cash 700,000. Notice my cash is now down to 1.2 million. I go ahead and I finish the construction. I go ahead and I don't set up accounts receivable for that last portion of billing. Remember, I had 500,000 left to go. So they're probably going to do what? Pay me at that point at the end of the contract. So I get cash, 500,000, and I just go ahead and I credit billings for 500,000. Okay. So now if you look at the billings account, notice that we have billed them now for the total price of the contract, which was $4 million, right? We got all our money on that. We look at our construction in progress account, and now what happens? Now we debit our cost of construction, 700,000. We credit our construction revenue, and now we are 100% done, aren't we? I don't mean 0.1, I mean times 1 or 100, 1.00, 100%. So it's 4 million times 100%, that's 4 million. We've taken 3.4 million of revenue up until now, so we can take 600,000 this year. So we take the 600,000 of revenue, we debit the construction in progress now for that final 100,000, or credited, excuse me, construction progress for that 100,000. That's the last part of the loss. We've taken now 200,000 loss on this. Now we're finally bringing that last part of the loss, aren't we? And when we're done, the construction in progress asset account equals the contract price, isn't it? It's everything we put in plus any profit, which was 0 on this, and it what? And it is now sitting there and matching the amount of the billings, which is this 4 million. Okay, so the contract construction progress and the contract price, the billing should match at the end of the year. So we go ahead and we have now completed the asset and we turn it over to the customer. So when that's the case, we debit our billings, closing that out. We credit construction in progress. That's why those two accounts were linked the whole time, as we were building up our costs and our billings, and they were sort of in a race to see who was in front, and if the billings was ahead of the construction in progress, then we had a liability. If the construction in progress was ahead of the billings, then we had a asset, right? Current asset, current liability, and it could go back and forth. But now we can go ahead and release the asset. Okay, our income statement, revenues minus costs, give us net income or loss. That's our final 100,000 loss. We lost 300,000 on this contract, didn't we? Because we spent 4.3 and the thing cost. We only got a sales price of 4 million. When we look at the balance sheet, we have our cash, no more account receivable, no more asset nor liability. That's all zeroed out now, isn't it? Then we look down and we have our common stock of 1.5. We have retained earnings of 300,000. Okay. Can you see some problems with percentage of completion? What's the problem with percentage of completion? Can change unpredictably. We did our best to come up with an estimate. I mean, think about it. If you were the fool that invested in this company in year 2, you'd be none too happy right now, right? Because you'd be sitting there saying, oh, wow, look at this. They're moving right along on this contract and da-da-da. And they may have several contracts that are all looking profitable. Stuff starts happening, and all of a sudden they start booking in all these losses, which are wiping out the profits you've seen in previous years, right? So what FASB tells companies that if you can't rely on your cost estimates, if you think there's some difficulty there, use completed contract. Don't take any profit on this until what? Until you are done. And the only thing that would change with the completed contract method is we would wipe out these profit estimations. We would never take the revenue and thus the profit on these. We would not do any of this until the what? Until the project is done. So it becomes an entire balance sheet thing in which we're doing what? We're capitalizing the cost of the construction in progress. We're doing that. We're obviously crediting cash and stuff as we spend those. We're billing and we're collecting on our billing. It's a balance sheet effort. There is no revenue. There is no expense recognized. There is no profit recognized until what? Until year 4 when the contract is done. And at the end of that thing, we would do what? Credit revenue for $4 million, debit expenses for $4.3 million, and show a loss. Well, I take that back, because we would have had to take a loss in year 3, because rule of conservatism says do what? Take the loss immediately. So in year 3, we would have taken whatever portion of revenue we were done up into that point, taken all of our cost up to that point as expense, taken a $200,000 loss in year 3, and then taken what? That final $100,000 loss in year 4. Okay, to catch it up 300,000. So worst case scenario, you have to take the losses if you have a loss contract, even under completed contract method. But some people would say, well, at least you didn't fool anybody, right? Now, the idea is that what? We should have pretty good engineering estimates. I mean, if we're in the business of building buildings, for a company, we should have pretty good engineering estimates, or what are our costs incurred to date? What are the costs to complete? So you shouldn't have this loss situation showing up too much. The other thing is that if you have several contracts going at any point in time, you net the gains and losses against the contract. So yeah, you might have 10 good contracts, 9 good contracts, and 1 dog that is what? Going to pull down the overall profitability of all the contracts. That's okay. But you account for them one at a time, one contract at a time away. We're talking about the percentage done versus the amount of revenue you're going to recognize in any period. Okay? Question. Okay, so what you need to do, guys, and I don't expect you to just, soak in this whole example the first time, but you absolutely need to kind of use this slide plus the example in tandem and sort of follow that whole back thing through. And once you look at it a couple times, you'll see it's pretty straightforward once you kind of build up a little muscle tissue around it. And I don't mean you have to be lifting weights while you do that. I just mean you look at it a few times, you rep it a few times, you'll get a little stronger with it. Okay? Now, I want to go back to this example because I kind of blew up this example beyond what it was intended to do, which was simply showing you how to calculate the profit on this thing at any point in time, because I could give you questions where it just asks you for the profit, and you'll see in some of the homework solutions they're just working on the profit part, and you're going to go, wait a minute, what about all those other journal entries we talked about? Well, it's fair for a question to just ask you the profit portion. Okay, so it's pretty easy the way you do this. Okay, just now leveraging off of our understanding, we were 50% done in year 1, weren't we? Okay, then what? Then we take the $4 million contract price minus the $3 million total estimated cost we think we're going to have on this contract, and so we have $1 million of profit. That's an estimate, isn't it? Okay, so we take that $1 million of profit times the 50%. That means that we'll take $500,000. That was our net income in year 1 on this, and since we have not recognized any profit previously, we attribute all of that profit to year 1. That was our year 1 profit. Okay, now you go into year 2 on this example. Remember, we said we were 75% done, but now because we think our costs are $3,200, we think our profit on this contract is only going to be $800, right? So we take the what? The 800, it's the contract price minus our estimated total cost on this contract. That gives you 800,000 times what? Times the 75%, 0.75, that gives me 600,000, but that's what I think I've earned on the total contract to date, right? Profit. Okay, so I've already taken 500, so that means what? That I'm going to take 100 this year, which ties up to our net income that we saw in the longer, more blown out example. Just showing you how to quickly get profit. Now notice down here, my buddy completed contract is saying what? No profit until we're done, right? We have to complete this, right? Okay, now notice that here, when we're dealing with the profit, or in this case now $200,000 loss, we don't care how done we are for the profit part of it, right? Because we're not just taking revenue minus expenses. So all you would have to do here is say, well, look, I've already taken 600,000 of 600,000 of profit on this, but now this contract is an overall loss of 200,000, isn't it? So my loss this year, my negative profit this year has to be what? 800,000. That wipes out the 600,000 sitting in retained earnings and catches me up to the current estimate of a $200,000 loss in this year. Do we have a loss of 800,000 in year 3 when we did it the long way? The way you do it if you're doing it the short way is you're just trying to do the profit part is you sit there and you pick up this 600,000 profit you've taken to date plus the total estimated loss of 200,000 is an $800,000 loss we have to take this year to wipe out the 600,000 from the previous years plus bring me up to date to 200,000 this year. And under rule of conservatism, my buddy completed contract will take that entire 200,000 loss this year. Rule of conservatism says take it immediately. So we have to take that whole amount. Then we get into the last year of this contract. We have a $300,000 loss. We've already taken what? 2, so we take 100 this year. Okay, now you can match these profit and loss numbers to the longer calculations that we did so you kind of understand the whole picture on this, but this is a good thing for you to look at and practice with if you're just saying, hey, how do I get to a question where they're just asking me the profit and loss piece, right? And then we take 100,000 loss completed contract. That'll catch us up to the 300,000 total loss on this thing. Okay, so with that, I want to stop there for a second. Huh? Yes, I will. Let me do it this way. I'll end show, and I'll tell it to keep, and I'll save it right now, okay? Oops, yeah, okay, it's called markup, so that's good. Okay, then I'll put that up. Okay, all right, good. But what I want to do, I think, is kind of figure this out as we go along. I think what I'm going to do in the 15 minutes or so we have left, let's go straight to the Chapter 5 quiz, in which we'll see some questions dealing with the contracting, okay, and contract accounting, and we'll zip down to those, and then we'll come back to some of these others. Okay, so let's look at this number 13. I think I got like 3 questions down here, and there's some more in the homework. Okay, again, for people that were looking for extra questions to work, there's more in the homework. Okay, but let's look at this number 13. During year 1, this is the quiz. There's more of these type of questions in the homework. During year 1, title company began construction on a project scheduled for completion in year 3. At December 31st, year 1, an overall loss was anticipated at contract completion. What would be the effect of the project on year 1 operating income under U.S. GAAP percentage of completion method? First of all, let me point out that the reason we call out US GAAP is that IFRS requires that you use percentage of completion. They do not allow the completed contract method, IFRS. So they could have just said then percentage of completion. I don't know. US GAAP percentage of completion, and they were going to compare completed contract. That's why they had to call out US GAAP, because IFRS does not allow completed contract. They only allow percentage of completion. Okay, so under percentage of completion, would our operating income decrease or no effect? Decrease. Good. We're going to wipe out what? Any profit we've taken previously plus enough to take the loss that we've realized, that we've recognized is going to happen in year one, right? Okay. All right. Good. How about completed contract? Decrease. Good. We have to take the whole loss immediately under both methods, don't we? Okay. So the answer there is decrease, decrease. If you're waiting for deeper meaning, stop. You sound a little underwhelmed by that. It's decrease, decrease, right? Okay, that's it. Okay, but it's really based on the last example we had. Now, we say now for number 14, they have two contracts that they're comparing side by side here, aren't they? Okay, and they want us to look at the two contracts, and they want us to use, and here they don't call out US GAAP, which they should, because if we're using completed contract, it's US GAAP, but never mind. We're not worried about IFRS anyway. So never mind. Okay, so we have these two contracts, and if Pell used completed contract, what amount of gross profit would Pell report in its, don't be afraid, 1992 income statement? Remember the accounting research bulletins? Remember the APO, the account, We have Committee on Accounting Procedure was the first entity that set accounting principles, and they set up accounting research bulletins. So this contractor accounting goes way back to accounting research bulletins. This has been around forever, okay, this method of accounting. That's why we can pick up a question that maybe somebody wrote that the AICPA released back in 1992. Up until 1996, the AICPA released all of their exams up until 1996. They stopped disclosing them in 96. Okay, so if you ever take the CPA exam, there are some questions that are still on the exam that you will be able to see prior to taking the exam because they were released prior to 1996, and they haven't released them since then, and so they're still good questions. Okay, if they release them after 1996, that means you'll never see them on the exam again. But some questions which have been released, like maybe this one, you may actually see on the exam, the same exact question. Okay. Now we have two contracts here, and notice that we have a contract price on the first one of $420, cost incurred $240, estimated cost to complete. So we think we're going to have total cost on this contract of how much? $360,000, don't we? Okay, and we are looking and seeing that the costs to date are what? $240,000. So this contract is what, about 2/3 done? Huh? I thought I heard somebody say no. It's about 2/3 done? Okay. Okay, good. Now what happens? What do we think the profit is going to be on this contract? $420,000 is the contract price. What's the total estimated cost of the contract? What's the total estimated cost? Cost to date plus estimated cost to complete. The total estimated cost is what? $360. So we're thinking we're going to have a profit of what? $60,000? On this? Good, thank you. And we think we are what? 2/3 done, so what's that, 40,000? Profit that we could potentially take on this contract, right? Versus what? Project 2, the contract price is 300,000. The costs incurred are 280. Total estimated cost of the contract is 40,000. So we think this contract's going to cost us what? 320,000, and we only have a contract price of what? $300,000 on this, so we got a $20,000 loss on this contract, don't we? Now, under completed contract method, should we take this loss? Under completed contract method, should we take that profit? No, because we're not done with that contract yet, right? So we would ignore the profit contract here to answer this, and we would do what? Take the full 20,000 loss on the loss contract. So the answer here is C. 20,000 loss contract, and we ignore the profit on the profit contract under completed contract method. Now, if we were using percentage of completion, using the same calculations, what would we do? We had a profit contract. This project 1 had a profit of what? 40,000. The project 2 had a loss of 20,000. So you'd net these two contracts so that we would show what? 20,000 profit on it? Answer A. Notice, guys, the analysis was purely on the profit here. You see why I showed you that little spreadsheet at the end? You didn't have to sit there and make all the journal entries and see what the income statement was going to look like. You could just focus on the profit portion of the two contracts to answer this question. That's that little cheat sheet I gave you at the end. Okay. Question on those? Question on those? Okay, so I'll tell you what we're going to do. When we come back on Wednesday, we're going to finish the quiz, right? We get out here at 2:45, right? So we're going to finish the quiz, and we're going to hit the ground running because we've got some catching up to do on chapter 7, I think, is next, right? Because we're not going to do chapter 6. Chapter 7 is next. Okay? All right, guys, I will see you on Wednesday. Oh, do me a favor and look at this quiz, the rest of the quiz, so that you're getting comfortable with the questions. We'll knock those out on Wednesday in the first portion of the class, and we'll finish up with the end of the class with the starting chapter 7. Save it? Yeah, okay. Thank you. All right, I'm going to save the recording, and I'm going to